Hey everybody, Chuck Barone. It is Tuesday, January the 16th, 2024. It's good to be back, guys. Even though it's been a long time, it seems like, since I've done a show. We had a little touch of the flu here. First me, then my assistant. His flu was a little different than mine, though. He had actually the swine flu, which is what we call the effects of a really, really great night the night before. And then we had the holiday yesterday, so it seems like it's been forever, but it's good to be back. And we got a lot to talk about, man. This is going to be a huge week coming up. And before I get started, though, let me take a second and welcome everybody to the show. And as always, thank you guys for your support. Means the world to us. It's the thing that keeps us doing these shows every day. Appreciate you guys. All right, so let's talk about this week coming, this crazy ass markets, the Fed, and all the fun stuff we've been having going on here, guys. It's just bananas right now because we're just swinging back and forth all over the place from we're going to cut rates, everything's going to be perfect, the economy's going to boom, everything's going to work great. Oh, hold on a second, we got all this happening and this and that, and now the market just reverses course. And you look at these numbers today, it's just crazy. Plus, we got a massive week of earnings coming out. Almost every bank and finance company that's significant anyway in this country reporting earnings this week. It's got Wall Street nervous as hell. Typically higher rates, they make money. They also got to pay more money. And it's going to be interesting to see how all of this stuff turns out. But let's talk about how these markets finished today. Stock market, just fear back in the market. You know, the greed was on a roll for a little while there. Fear returns with a vengeance today. You got the Dow tanking 231 points, down to 37,361. The NASDAQ falls 28 points, 14,944. S&P, the broader market, falls 17 points, 4765. So stocks down across the board. A lot of factors. We'll talk about some of those as to why these markets today were not so great. I think there's just no certainty as far as the direction this economy is going to take this year. You know, at first it was all sunshine and roses, man. We're going to have a great year. Fed's going to cut rates 5 or 6 or however many times. Everything's going to boom, boom, boom. We made it through this, big inflation without a recession, with all these rate hikes, no recession. Well, I've had my doubts for a while, guys. I just don't know how we get this perfect ending. I've never seen that work out in anything in life. And that's why I have my doubts it's going to work out like that this time. But the market's been, I've been pretty much saying that the entire time. I haven't wavered much. The market obviously been back and forth, bulls, bears tugging at the rope. So right now the bear is winning the fight. Bond market, same thing, man. Look at these yields today. So the 10-year jumps 11 basis points, now at 4.06%. The 2-year jumps 8 basis points, 4.22%. Bond yields gyrating all over the place, man. The 10-year was coming down, looking like it was heading toward 3.5. Now right back up over 4%. The 2-year was actually under 4. Now at 4.2, almost 4.25. Bond market doesn't typically do this, right? And now I was reading a pretty big article today saying, a lot of the big professional money, hedge funds and private equity groups, tucking their money away, man, holding cash, buying commodities, buying real estate, places to store money that is not really subject to the wildness of these stock and bond markets. Dollar today, dollar with higher rates maybe, or rates not going to get cut as much, dollar rallying continues, man. Up almost 0.75 points on the index today. Now at 103.34, dollar strengthening. We were on our way down to 100. Then it bounced back up to 102. I thought it would kind of stick around there for a little bit. Still surging though, man. Dollar getting stronger. As a result, gold and silver, not a happy day for gold and silver today. Gold falling $26.50 an ounce. Sitting at $2,028.80 for an ounce of gold. Still a pretty decent price. Silver falling 31 cents. now sitting at $22.89 for an ounce of silver. I think that, it's disappointing. I really thought silver would be back above 25. And it will get there, and gold's going to continue to rally too. This dollar, where it is now, sooner or later the Federal Reserve is going to cut these rates. It's just a matter of when does that happen. So if we're not trading the rumors or the story of the day in the market, and we believe that the Fed is going to cut rates sooner or later, we know that gold and silver are going to rally when that happens. So hang in there, guys. Oil today falling, down 76 cents a barrel, now sitting at $71.92 for a barrel of West Texas Intermediate. Again, guys, exactly where we expect it to be. It's just been zigzagging up, but it's in that trough between 70 and 75, and I believe that's where it's going to stay for a while until we have reason to see it go up or down. We haven't seen that yet. Bitcoin rallies up $638 today, $43,447 for Bitcoin. A good strong price, actually down a little bit from when the ETFs were announced. I haven't really followed closely to see what kind of volume they're doing on those yet. We'll get into that a little bit. But Bitcoin do you think Bitcoin's ever going to go back down to 16,000 where it was late last year? I don't know, guys. Anyway, this week, as I do at the beginning of every week, let's talk about what we're going to be seeing this week. As I mentioned, we got a huge earnings week, man. This is going to be, ordinarily we don't talk much about earnings because the companies reporting are typically not going to move markets when their earnings are reported, for good or for bad. Now, if there's a whole market earnings are rising, obviously that's going to happen. But the finance companies, the Wall Street companies, are the ones that everybody tends to look at. You got banks this week like crazy. You got Goldman, you got Morgan Stanley, all the finance companies coming out with their earnings this week. Going to be interesting to see how that affects the market. Today we're going to get Empire Manufacturing. I haven't seen that before we recorded this show. It's expected to be down 4 points on the index. Was down 14 points last month, so the manufacturing index to continue its way down. Tomorrow we'll get business inventories, which are expected to be down. Capacity utilization also down. We're going to get import price index with a strong dollar. I'm expecting those will be down. And we're going to get retail sales numbers. The market kind of, the analysts kind of going back and forth on this one, but the consensus is retail sales will be up. On Thursday, we'll get building permits. What's going to happen with real estate? We'll get housing starts. Building permits are expected to be up. Housing starts down, which is strange. We're also going to get jobless claims, which is always the big news on Thursday. This week they're expecting 206,000 versus 202,000 last week. We'll see. They've been missing that pretty bad lately. We'll get the Philly Fed survey, which is also expected to be down. That's an important one because that talks about manufacturing, consumer trends, and all different kind of stuff. Expected to be not good news. Friday we'll get existing home sales, which are expected to be up. But that's just off the floor. No, existing homes sales can't be high because there are no existing homes for sale, right? And also on Friday, we will get the University of Michigan Consumer Index. That's another really important one, like the Philly Fed survey. University of Michigan Index is expected to be unchanged this month. We'll see where that goes, right? Okay, a couple little tidbits before we go today. U.S. Treasuries. Now they're worried about the amount of treasuries that are going to be hitting the markets this year. U.S. Treasury sales are expected to double this year to over $2 trillion. Analysts are now concerned that this kind of supply, a massive influx of supply, could hinder Fed efforts to bring rates down. Fed controls only overnight rates. If the U.S. is going to be selling 30-year bonds and a massive amount of them, that could drive rates higher to get people to buy those bonds, which would go counter to what the Fed's hoping to do. It's going to be really a fascinating things They worry about the government's lack of fiscal discipline. They're, they refuse to acknowledge that there's limits to what they can spend. And of course, the market's worried, who's going to buy all these bonds? Foreign interest seems to be drying up. China not buying bonds. Do we end up going back to the Federal Reserve to buy this debt? That would be the worst of all worlds, right? So no one's sure how this is all going to affect the market, but it's going to be a fascinating thing to see. So you're going to have the Fed actually cutting rates, trying to spur the economy on, get people back started in housing and back started in certain things that are interest rate sensitive, get people back out, fire the economy up. At the same time, you're going to have the U.S. Treasury and the government borrowing such insane amounts of money that it's going to work as a perfect counterweight to the Fed cuts. So what you're going to see is you're going to go from inverted to the hugely steepest rate chart on the other way around, where you're going to have overnight rates near zippity, and you're going to have 30-year rates way the hell up here. It's going to be crazy to watch it, guys, right? Then you got, on top of all this massive supply, because you can still expect municipalities, corporations, and everybody else to be issuing debt like crazy. That's not going to change. But at the same time, U.S. corporate debt defaults jumping 80% last year. 80%. Now, don't get me wrong, it's still not like an epidemic number. It's just showing the trend is pretty dramatic. And 2024, here's the great quote, expected to see a further deterioration of corporate credit globally. Wow. Now they're talking typically, these companies that are defaulting, these are not the AAA rated, okay? These are the BBB, these are the junk bond statusy stuff, the stuff that people buy to reach for yield. I would tell you all right now, if you're holding corporate paper, okay, if you're holding corporate bonds, get rid of anything in there that isn't just absolutely foolproof. Don't take any chances with this stuff, guys. If they're saying corporate defaults have been up 80% and they're going to get worse even this year, why take a chance? For a fraction of a point of interest? Nah, don't do it. Anything that is not absolutely airtight, time to get rid of anything that's less than airtight. Then today, to finish things up, you got these Fed yo-yos out there again, talking down rate cuts. The Fed hawks chirping like crazy. Waller out there today saying the Fed has no rush at all to lower rates. Well, the market's not, market's already pricing in these rate cuts. So having these guys come out here, now I guess they're just trying to slow Wall Street down, because what's going to happen is if March rolls around and there's still no sign of the Fed going to cut rates, the market will react to that. But not helpful when you have a market tanking like it is today to have these guys out there adding fuel to that fire. Anyway, guys, that's it for the day. We appreciate your support. I promise you we will be here today, tomorrow, Thursday, and Friday to get shows out every day this week. We'll bring you guys the news you need. As always, we appreciate your support. We'll be back tomorrow, guys. Till then, take care. Thanks.